Welcome everybody to this series of 3 short videos on how to read and analyze financial reports for your small business. My name is Tina Odleifson and I'm a small business advisor with the Maine SBDC. And before that, I was a business owner who had to learn her own bookkeeping and how to use financial reports so that they actually help me be more profitable. And my goal here is to help you understand reports so that you can use them as a tool to manage your business as well. And the reason that this is so important is that unfortunately almost 50% of businesses fail by within 5 years in the United States, and 82% of those businesses cited financial management and particularly cash flow management as the reason for that failure. And that can all be avoided with both careful planning and also an understanding of how to use your financial reports to manage your business. So what we're going to be doing is 3 separate videos on each of the major financial statements. Right now, we're going to talk about the profit and loss statement, also known as the income statement. We're going to talk about the balance sheet and then the statement of cash flows. And what we're going to do is dive a little bit deeper into each one of these so that you can really get the information you need to manage your business and make actual decisions within your business. A lot of business owners stop after the profit and loss statement and don't really know how to use the other 2 statements. So hopefully this will really help you move forward. So a lot of businesses and business owners are kept up at night. I know I was, when they start stressing over kind of some really important questions about their business. And the only way that you can actually get these questions answered is through the financial reports. Financial reports are the tool that we have. It's like the language of business. So by having accurate and up-to-date financial reports, they really help you get control over your business so that you can sleep better at night and control what happens in your business. It's kind of like if you go on a long journey and you don't take a map with you, that can get a little scary. Some parts of it might be a little fun, but for the most part, it's good to have a map. And that's what your financial reports do for you when they're up to date and they're accurate. They help you get control and they help you make better decisions. They're absolutely essential when it comes to applying for any kind of funding. So if you want to get a loan or a line of credit, or maybe you're going to make a pitch to some investors, family and friends, they want to know what's happening inside your business, so you must have these reports. And obviously, everybody has to do taxes at the end of the year. I think a lot of business owners are doing their financial reporting just to do their taxes, but we want to go much deeper and help you understand what this information is that's really going to help you have a successful business. So as I said, the 3 major reports we're going to look at are the profit and loss statement, which is also known as the income statement. Who knows why they decided to make 2 different titles for this, but it's the same exact thing. We're going to look at the balance sheet and the statement of cash flows, and we're going to dive in deeper into what those all mean. And really the purpose of these 3 videos is to help demystify finance for small businesses so that you can get it. These a lot of times there's terminology and concepts that get used and thrown about that I think intimidate small business owners. So we really want to help you know that it's not as complicated as sometimes people make it seem. So the first major question is, how do financial reports even get created? And basically, every small business has things that go in and out of its bank accounts, its credit card accounts, its loan accounts, and those are called financial transactions. They are when you buy something at the store, when you use your credit card, when you pay your staff, the money that goes into your account from sales revenue, the money that you might get from a loan, when you buy big things like equipment or real estate. All of those things are financial transactions. So we put those into our accounting software program. QuickBooks is a very popular one. There's other ones out there. And basically what an accounting software program is doing is categorizing those. Same kind of idea as the Dewey Decimal System in books. It's just putting them into categories. And then from that system, those accounts, also the categories can be thought of as, or accounts can be thought of as categories. Those accounts are like buckets. So each financial transaction goes into some buckets. And then when we want to summarize what's in those buckets, that's what the financial statements are. So some transactions end up on an income statement and some end up on a balance sheet. So there's two separate statements, different information, different accounts, different buckets of information. The third statement that we look at, called the statement of cash flows, doesn't actually have its own accounts in an accounting system. We're going to borrow accounts from the other two statements to create that statement. So everything ends up in two places inside the accounting software: income statement or the balance sheet. So before we begin, I want to offer you a visual because I think it can be really helpful in just understanding what these reports are telling you. So I want you to think of your business like it's an apple tree, and you are in the business of growing, harvesting, and selling apples. Each part of this tree is telling you different information about the health of your business generally, and each report reports on different parts of that tree. And we need all of those reports to get the big picture understanding of how healthy our business is. So the profit and loss statement, same as the income statement, is the one that you use to take a look at how well you're doing at growing, harvesting, and selling your apples. It's the top portion of that tree. That's the one that most business owners are looking at exclusively because it's kind of easy to understand. You bring money in from sales, expenses go out, you have hopefully some profit left. But if we only looked at that part of the tree, we really wouldn't understand what's going on with the rest of our business. So the balance sheet is the thing that we use to understand how stable and strong is this business. Is it growing in a sustainable way so it can support the activity of growing apples? Is it not growing at all? Is it almost contracting? Same idea as the rings on a tree trunk that you see, the growth rings. It can be either growing and getting bigger and stronger, or it can be contracting. That's what the balance sheet is going to tell you about your business. And you need to know, otherwise your tree might topple over. And then finally, the statement of cash flows is the same idea as monitoring the flow of water to the root system of your tree. If that water gets turned off, the tree is eventually going to die and the whole thing's going to collapse. And it's the same thing in a business. If you're not carefully monitoring how that flow is working and it gets down to a trickle or it stops, then you're in trouble. So that's why we need the cash flow statement to help us understand what's happening to the root system. So that everything taken together is what these three reports are telling you. And that's why each of them is so important. So we're starting off with the profit and loss statement, again, known as the income statement, and it's the one that probably most of you already know. So this is an income statement that I made up for my business, and it is reflecting what's happening in this business over a period of time. We can run it from, for a month and say what happened in the last 30 days. We can run it for a quarter, and we often run it for a year, because that's what we report on to the IRS. So the first section of every income statement is the revenue section. That reflects the sales that are coming into your business from the product or the service that you're selling. And oftentimes there's multiple revenue streams, and revenue streams are different parts or different ways that a business makes money. It's not going to be everything you sell. You can get that information from sales reports inside your accounting software, but sometimes you need to understand what the major contributors are. In this case, my business has an apple business, but they also make pies. So they want to understand what each part of the business is bringing in. The second part is the costs of goods sold. And this is one of my favorite sections. And it's often reflected on statements for businesses that sell products, but it can be reflected on a service business. If you provide your service, say, in a certain amount of time, it's really important to control the labor costs around that service, and the labor costs are directly related to what you're selling, then you might have cost of goods sold for a service business. Cost of goods sold is an expense, but the reason that it's not under that expense section is because it's directly tied to the creation of the revenue. So in order to get the apples and the pies into the hands of customers, I have to spend money on labor and ingredients. And it's called a direct cost, directly tied. The more revenue I have, the more labor and ingredients I have. So it's like those things are literally tied together. And we will see in just a few more slides why that becomes particularly important to separate out from the rest of our expenses. And in the expense section, this is the section that are typically costs that are not tied directly to revenue. They are what we call operating costs or overhead costs. And there's things that you pay for that no matter how much revenue you bring in, you're going to have these expenses. You're going to have to pay your rent, excuse me, no matter what. You're going to have to pay insurance no matter what. You're going to have to pay salaries no matter what. Advertising is maybe something that you can control, but it's considered, a necessary expense to have a business. So that's the operating expense section. And in my sample here, it's very abbreviated. You're going to see typically a lot more expenses like repair and maintenance costs, or travel and meals costs, or cost to be part of memberships in organizations. There's a lot more that typically go on here, but this is shorter just for demonstration purposes. And then the bottom section of an income statement, we get our net ordinary income, which is revenue minus cost of goods sold minus expenses. And then we have a section that's other income and other revenue. And the reason that that's there is because money still comes into businesses or goes out of businesses that are not necessarily associated with why they're in business, but we still need to capture that information. So for example, in this part, my business sold a piece of equipment. It had gotten to the end of its useful life. And so they made some money, but they're not in the business of selling equipment. So that's why it's on the bottom, because we want to keep it out of the analysis of how we're doing as a business. So we have our net profit, $61,500. And then we say, well, so what? What do we do with this? And the place that a lot of businesses stop is just looking at what's called the bottom line, that final number that says, did we make profit or did we not make profit? And that's certainly where you want to start, but it's where you want to start, not where you want to end. So obviously you're asking yourself, was this good? Was this not what I expected? But then you want to go in and look in more detail at every line item and ask yourself the question, does this make sense? There's a lot of times that people look at these reports, and I've worked with clients who have had other people do their bookkeeping, and when they go back in and actually look at the report, they say things like, well, we didn't spend money on that, or where's the revenue from that big client? What's happening here? So the first thing, easy thing you want to do is just make sure the numbers are making sense. And if you see anything unusual, you want to investigate that. But the real value here comes from comparing this information to something else, because that puts it in context and helps us understand it better. So one of the things you do with an income statement or profit and loss statement is you want to look at how it compares to your past. So you can run a report on this month compared to last month, this year compared to last year, this quarter compared to the quarter in the year before, or the quarter in the current year, because that gives us information. Is it better or worse? And why is that happening? If you are a brand new business and you don't have history, then you can compare it to the projections you made for your business that you hopefully made going into your first year and what you thought you would be making. Sometimes we do those projections and things end up being very different, and it's a really good idea to take a look and ask yourself, why is this so different than I thought it would be? What's happening here? And the third place that you can compare your numbers to is your industry. And here at the SBDC, we have industry data to help you understand how you stack up within your industry. And this can be super helpful, because if you find out that the average net profit for your business is 10%, but you're doing 3 or 4%, there's something going on there. There's some way that you're managing your business that's different than other businesses in the industry. If your cost of goods sold is very different, that's a really important metric to look at, because it might mean that you're spending too much money on the ingredients and the labor going into making your product, and you might have a business model that's not going to work. So we make those comparisons, and then when we look at that, it allows us to take action, specific things you can do, like change your prices or set up a marketing campaign because your revenue isn't where you thought it would be. Or it's going to force you to look at efficiencies. Do I have too much labor? Am I paying too much for supplies? It might make you consider finding a different supplier or talking to your supplier about how you can get better prices. And the way that we really get into doing this is by using something called financial ratios. This is where, some people are like, forget it. This is math. This is stuff I don't want to know about. But all a ratio is the relationship between two things. It just shows us the context of information so that we have that comparison and it gives us meaning. That's all it is. They're widely used to analyze the health of businesses by bankers and investors. And ratios are something that you as a small business owner can also use to really understand what's happening. So if we go back to our income statement here, you'll see on the right-hand side that there is a column for ratios. And inside an income statement, the ratio that we use is every line compared to our total revenue line. That's why that total revenue is in red. And that is what's going to give us meaningful information. So for example, if we take our apples line, we got $150,000 from apples, and we divide it by our total revenue line of 500,000, we get 0.3, which means 30%. So that's telling us that 30% of our total revenue came from apples. We do the same thing with pies. 70% is coming from pies. Really useful information, because if you're going to make a major change to how you are going to run your business, say you decide you don't want to do pies anymore, you might want to rethink that, because right now that's where most of your revenue is coming from. In the cost of goods sold section, this is where this gets really fun and really useful. So in cost of goods sold, what that's saying is if we take our labor line of 165,000 and we divide it by 500,000, we get 0.33 or 33%. What that's telling us is that for the revenue that we brought in, 33% of that revenue went out the door to pay for labor just to get that product into the hands of the customer. Another way to think about it is for every dollar that you brought in sales, 33 cents went out the door immediately to pay for labor. We do those same calculations for ingredients. 100,000 divided by 500,000 is 0.2 or 20%. So 20% of our dollar, or 20 cents on every dollar, is going out the door immediately just to get it into the hands of the customer. So our total cost of goods sold are 53%, which means 53 cents on every dollar goes out the door before we even get to our operating expenses or our profitability. That leaves us with what's called a gross profit and a gross profit margin. So we have 47 cents left on every dollar to contribute. It's sometimes actually called the contribution margin, to contribute to paying the rest of our expenses and getting profit. The reason this becomes so important, and the only way you can actually see this information is through financial ratios, is say you are looking at a financial statement, your income statement for a year, and you actually made more. You brought in $750,000 in revenue. And you're like, this is great. But if you don't use financial ratios, you might not pick up on some really important trends. What if when you did those financial ratios, you actually found that your cost of goods sold as a percentage of your revenue was actually higher? what if the next year, even though you made more revenue, more money went out the door, more percentage of each dollar went out the door to get that into the arms of the customer. Really critical information, because if that's happening, you're on a path of something that's going to be non-sustainable. So what we do, if we see that these numbers are higher from the previous year, we want to ask ourselves why. And this is where you can take actual action inside your business to change things. So say that labor cost went up to 40% of your every dollar coming in. Something happened. Something is not working the same way it did the year before. So it could be that you have too many people scheduled at the same time. It might be that something is taking a lot longer now than it used to. Those are the kinds of things you want to investigate. When it comes to ingredients in this scenario, you would want to go back and say, what's happening? Is there more waste going into the trash than went before? Is there another way we can use up our ingredients in a more efficient manner? And if none of those things are happening, then it might be that your prices from your vendors increased and you didn't really take note of that. And if that's the case, then you want to be talking to your vendors and find out, why their prices increased, and if there's ways that you could be ordering from them to reduce your costs. Sometimes you get bigger cases, bigger amounts of things, and you get better prices. If you've gone through this analysis and none of those things are going to help you, then it's time to increase your own prices. And this is something that a lot of small businesses really are hesitant to do because they think it's going to alienate their customers. But if you don't keep track of this and see what's happening and raise your prices incrementally, you'll get to a point where you have to raise them drastically. And that does alienate customers. But if you can make sure you're watching these trends, then you'll know what to do on a smaller scale. So that's why the cost of goods sold section and financial ratios are my favorite, because it really tells me a lot about what I can do as a business owner to change things and get myself on a better track. When we look at our expense section, our overhead section, same idea. We take each of these numbers and we divide them by the revenue number so that we can understand for every dollar how much we're paying in for each of these costs. Our total amount of costs are 35% of every dollar. So, or 35% of our revenue is going to operating costs. And that means 35 cents on every dollar is going out the door for the rest of these costs. Again, this is where comparing yourself to your industry can be really helpful. You may find that people in the same industry spend a lot less on something like rent or salaries or insurance. And, you certainly can see if there's a trend upward in the cost of these things that you hadn't noticed before. So we take our revenue, we then look at our gross margin. We've got 47 cents to pay for the rest of our expenses. So now 35 cents just went out the door. That leaves us, when we factor in that other income and expense line, with 12.3% of our revenue is left after all of these expenses. And that's what you want to be looking at, because even if you got more revenue and you have a higher amount of money, it might not be at the level that it really should be if you don't take a deeper dive into these numbers and looking at your industry, and then of course looking at your own history. So that is what you can do with an income statement to dive much deeper into it and to actually make decisions that are going to affect your business and then ultimately affect your profitability. So we are going to end this video and move on to the balance sheet. So after you've watched this one, if you want to just sit with it for a while and try to understand it, do that and come back later and take a look at our next video, which is going to be on the balance sheet.